Ever wonder how the biggest banks in the world legally rigged the entire financial system? It wasn't a market, it was a cartel. This is the story of the LIBOR manipulation scandal. A banking cartel manipulation so vast, it touched every mortgage rate, loan, and derivative on the planet. This is the definitive financial crime documentary on interest rate rigging. We'll expose the traders' chat messages scandal, the raw arrogance at the heart of the fraud. Exactly how LIBOR was rigged, from the inside. The LIBOR submissions rigging was a daily game. We'll follow the man they called the ringleader, Tom Hayes, the LIBOR trader, and the institutions like Barclays and UBS. This is more than the Barclays-UBS LIBOR fraud. It's the blueprint for benchmark interest rate fraud. This is how white-collar crime almost broke the world. Let's expose the scandal.
Have you ever felt like the stock market is rigged? I'm not talking about a hunch, but a deep-seated conviction that the wealth you work for is being siphoned into a system designed for someone else's benefit. What if that feeling isn't paranoia, but a glimpse behind the curtain of Wall Street corruption? What if the celebrated market isn't a market at all, but a casino where the house, a system built on corporate greed, always wins? Stick with me, because what you're about to discover is the backbone of a $7 trillion lie. Let me paint a picture. Remember the 2008 bailouts? Trillions in public money flooded Wall Street to save the system. But then, a new financial scandal emerged. In the last decade alone, corporate giants spent over $7 trillion, not on innovation or wages, but on stock buybacks or share buybacks. This staggering sum, greater than most national economies, was used in a circular, self-serving scheme. Think about it. You work, save, and invest. Meanwhile, powerful companies use profits and cheap debt for what amounts to legal fraud, buying their own shares to artificially inflate the price. This isn't productive capitalism. It's legal market manipulation. It's the engine of a white-collar crime business model. This is no victimless strategy. It's a direct pipeline for wealth transfer, fueling income inequality. It prioritizes short-term stock pops, which directly boost lavish CEO compensation, over long-term company health, R&D, and worker well-being. The game is rigged, and corporate stock buybacks are the hidden lever. So if you wonder why CEO pay soars while wages stall, or why the market feels detached from reality, you're asking the right questions. The answer is this $7 trillion shell game. We're going to expose how this practice evolved from a crime called market manipulation into a sanctified ritual that corrupts shareholder value. We'll peel back the layers of corporate fraud and follow the money to the heart of an economic conspiracy happening in broad daylight. It's time to see it for what it is. But before we pull that thread and trace this $7 trillion lie back to its origin, to the exact moment a crime was rebranded as a savvy financial strategy, I need to pause here for a second. Because this isn't just a lecture. This is a conversation we need to have, out in the open. If this resonates with you, if you're watching this feeling that mix of anger and clarity, I need you to do something for me right now. Hit that like button. It sounds simple, but it's a signal. It tells the algorithm that this isn't just background noise. It's crucial knowledge that people need to see. It helps push this video beyond this screen and into the feeds of others who are asking the same questions, who feel that same disconnect between the marketed dream and their financial reality. Your click amplifies this message exponentially. More importantly, I want to hear from the US and want you. This channel is built on pulling back the curtain, but the real power comes from the community that forms in the comments. So tell me, what part of this $7 trillion shell game hit you the hardest? Was it the sheer scale of it, the brazen transfer of wealth, or the personal feeling of a rigged system? Maybe you have your own story or observation about how this financial engineering has played out. Drop a comment below. That dialogue, your voice added to this, is what transforms a monologue into a movement. It's how we connect the dots together and prove this isn't some niche concern. It's the central fault line in our economy. And if you're thinking, finally, someone is connecting the dots between Wall Street's games and why my economic life feels so precarious, then you need to subscribe and hit that notification bell. This is just the first layer. We're going to dive deeper into the history, into the 1980s ruling that flipped the switch and made this manipulation legal. We'll expose the specific executive pay schemes that make this corruption inevitable, and we'll name the companies that have hollowed themselves out for a temporary stock boost. Your subscription is your ticket to that next level of understanding. It's you saying, I'm in. I want to see the full blueprint of this architecture of corruption. By joining, you're not just passively watching. You're actively ensuring this investigation continues, that we keep following the money and the power to its source. Because here's the truth. This system thrives on silence and complexity. It banks on us feeling too overwhelmed or too isolated to question it. But every like that spreads this video, every comment that shares a perspective, and every new subscriber who joins this community chips away at that power. It creates a network of people who can see the machine for what it is, and that is the first, most fundamental step toward changing it. So let's build that understanding together. With that collective energy fueling us, let's rewind the clock and uncover the pivotal moment this all began. So with that collective energy, let's rewind the tape to the moment the rules of the game were secretly rewritten. Because to understand how we got here, you have to understand that this wasn't always legal. In fact, for most of modern financial history, what we now call a stock buyback was considered a felony. That's right. Until 1982, the Securities and Exchange Commission, the SEC, categorically viewed a company manipulating its own share price through repurchases as market manipulation, a prosecutable crime. They saw it for what it is, a way to artificially inflate value, to deceive investors, and to create a false market. The mindset was that markets should reflect genuine value and future prospects, not financial engineering. The transformation happened quietly, in the halls of power, under the banner of deregulation. In 1982, the Reagan administration's SEC introduced a little-known rule called 10b-18. It was presented as a measure to provide clarity and a safe harbor for companies. In reality, it was a get-out-of-jail-free card. This rule created a legal loophole so wide you could drive a $7 trillion truck through it. It said essentially, if you follow these specific procedures, how much you buy, when you buy it, through which broker, you will be immune from prosecution for manipulation. Overnight, a crime was rebranded as a corporate strategy. This was the ignition switch for the entire engine, but it needed a philosophy to justify it, a new mentalidad for the C-suite. Enter the radical rise of shareholder value theory. Now, on the surface, it sounds almost reasonable. A company's primary duty is to its shareholders, but this was twisted into a monstrous short-term directive. It became a mantra that said maximizing the quarterly stock price is the only true measure of success. Not building better products, not investing in a workforce, not ensuring long-term stability, just the stock price. This ideology provided the perfect embastideursement or in-cover story. It transformed CEOs from company builders into stock price managers. Their journey was no longer about innovation, but about financial alchemy, finding the fastest route to pump that number, consequences be damned. Let me make this concrete with a metaphor. Imagine a brilliant factory owner. His factory makes the best widgets in town. Every year he has a choice. He can reinvest his profits, buy new, faster machines, train his workers, research a new, better widget. That's the deregulation that builds real, lasting value. Or he can take every single dollar of profit and use it to buy back the little paper certificates that say, I own this factory from other people. The factory itself starts to decay. The machines get old, the workers get demoralized, the new widget never gets invented. But for a while, because there are fewer and fewer of those ownership certificates floating around, each one seems more scarce and valuable. The paper price soars. He looks wildly successful on paper. But the truth occultus is that the underlying asset, the actual productive factory, is rotting from within. Eventually, the roof caves in. The impact-wise is catastrophic, but by then, the owner has sold his now expensive paper and moved on. This isn't capitalism. It's extractive financialism. It's the one revelation that we've confused the ticker symbol for the company itself. Now, I want to go even deeper, because this historical shift and this justifying ideology created a perfect storm. It set the stage for the actual mechanism of the crime, how this abstract rule and philosophy translate into the direct personal incentives that drive executives to literally cannibalize their own companies. It's a system of rewards so perverse, it guarantees the outcome we're seeing. What one word comes to mind after hearing this history? Comment below. Point of no return. That point of no return wasn't just philosophical. It wired a new, destructive operating system directly into the heart of corporate America. Now I want to go even deeper into this subject, to pull the cover off the machinery itself, and show you the three interlocking gears that make this fraud function in broad daylight. This is where the abstract history becomes concrete personal incentive, where the loophole is exploited with surgical precision. The first gear is pure financial illusion, a magic trick played on every investor watching their portfolio. It's called earnings per share, or EPS. It's the golden metric, the number that headlines are made of. Here's the simple, devastating math. Profit divided by number of shares equals EPS. Now, if you can't dramatically grow the profit, the hard part, what's the easiest way to make that EPS number soar? You shrink the denominator. You reduce the number of shares outstanding. That's the pars primera revelation. A stock buyback artificially inflates this all-important number without the company earning a single extra dollar. It's cosmetic surgery on the balance sheet. The market celebrates rising earnings, but it's a mirage. No new product was launched, no new market was conquered. Value wasn't created, it was merely concentrated, and the impact to bow is a distorted signal that misguides every investment decision. But why would a CEO choose this illusion over real building? Enter the second and most perverse gear, the compensation scheme. This is the idea verdade oculta that ties it all together. Modern executive pay is no longer a salary, it's a bet. The vast majority of a CEO's potential wealth comes in the form of stock awards and stock options, the right to buy shares at a set price in the future. Their personal fortune is directly, exquisitely tied to the short-term stock price. So, what is their primary mentalidad? It's not, how do I build a company that thrives in 10 years? It is, with relentless focus, how do I get the stock price up before my options vest? A buyback is the most powerful, predictable lever they can pull. It's a guaranteed short-term pop. So they make the decision now to allocate capital, not to the future, but to their own personal balance sheet. They are incentivized to cannibalize the very company they were hired to steward. This leads us to the third catastrophic gear, the vicious self-reinforcing cycle. For the past decade, we've lived in an era of historically cheap debt. Money was almost free. So, what did many corporations do? They went on a borrowing binge. They took out colossal multi-billion-dollar loans. But instead of using that free money to fund a risky jornada of innovation or to shore up their foundations, they used it for the one thing guaranteed to move the needle for their own pay: more buybacks. They leveraged the company's future to pump the stock's present. The stock price climbs, executives cash out their options, collect their bonuses, and are hailed as geniuses. Meanwhile, the company itself is left hollowed out, burdened with debt, and stripped of the resources it needs to adapt. It becomes a fragile shell, vulnerable to any shift in the wind. This isn't strategy. It is a legal, institutionalized pump and dump, where the pump is funded by debt, and the dump is when the executives sell. Seeing these gears turn together changes everything. It transforms a complex financial story into a clear story of misaligned power. What single word describes this system of incentives to you? Comment below. Perverse. That word, perverse, hits the nail on the head because it reveals the true cost. This isn't a victimless financial engineering. Every single dollar funneled into this cycle of manipulation represents a decision not to fund something else. It's a massive silent transfer of possibility. So now I want to go even deeper into this subject and look at the real-world wreckage. To trace the phantom limbs of what that $7 trillion could have built, we need to talk about the victims. The first and most direct victim is the collective American worker and the engine of innovation. While corporate profits in the S&P 500 have soared to dizzying heights, wage growth for the average worker has remained stubbornly flat for decades. It's the great disconnect. At the same time, investment in the future, in research and development, in new technologies, in worker training, has stagnated or declined as a priority for many major firms. Why? The capital that could fund a transformation is being diverted. The mindset is no longer invest to grow, but extract to boost. Every billion spent on buybacks is a billion not spent on the laboratories, the skilled engineers, or the higher wages that actually build competitive advantage and shared prosperity. It's a starvation diet for the real economy. This leads to the second victim, the long-term health and resilience of the company itself. We've seen this tragic movie play out. Take a company like Boeing. For years, it was celebrated on Wall Street for its aggressive stock buyback programs, returning tens of billions to shareholders. But to fund this, corners were cut. Investment in engineering oversight, in quality control, in the deep institutional knowledge that ensures safety, was squeezed. The poor impact was catastrophic. The 737 MAX crises weren't just a tragic accident. They were a direct symptom of a culture that prioritized financial engineering over engineering excellence. The company's reputation, its balance sheet, and tragically lives were shattered. It's a stark revelation. When you hollow out your core to prop up your stock price, you are building a palace on sand. The same story echoes in the fall of giants like GE, a company that became a master of financial manipulation while its industrial crown jewels rusted from neglect. But the third and most profound victim is the stability and fairness of our entire economic system, and by extension, every one of us. This $7 trillion drain represents a monumental failure of allocation. That capital could have been the jornada toward a green energy transition, building infrastructure resilient to climate change. It could have fortified our healthcare system, funded breakthrough medicines, or built economic buffers against future pandemics. It could have raised wages, lowering the desperate need for consumer debt, or it could have lowered prices by funding productivity gains. Instead, it fueled unprecedented wealth concentration, making the market more volatile and our society more fragile. This is the ultimate truth occulta. Stock buybacks are a mechanism for systemic risk. They take capital that should be building a better, more stable, more innovative future and convert it into a subsidy for asset inflation for the already wealthy. It is a planet-scale misallocation of resources, a theft from tomorrow to pay for today's executive bonus. Seeing this full picture, the stolen wages, the hollowed companies, the stolen future, frames this not as a financial debate, but as a moral and practical one. What's the one word for what that $7 trillion could have been? Comment below. Potential. That lost potential is the silent cost of a system we're told is simply efficient capitalism at work. But now, I want to go even deeper into this subject to confront the most common and seductive defense head-on. You'll hear it everywhere. But it's their money. They can do what they want with their profits. That's just the free market. This argument sounds reasonable on its surface, appealing to a deep-seated belief in property rights. But it's built on a foundation of sand. It's the ultimate disguise, and we need to dismantle it. First, the truth occulta about it is that a massive portion of the capital used for these buybacks isn't some pristine, fairly earned profit in a vacuum. It comes from three twisted sources. 1. Tax subsidies and loopholes. Corporate tax rates have plummeted for decades, and trillions in profits are held offshore or shielded, money that should fund the public infrastructure, education, research, transportation, that businesses themselves rely on. 2. Public bailouts. We saw it in 2008, we saw it during the pandemic. When crisis hits, the state floods these companies with liquidity, socializing their risks. And what do they do when they get back on their feet? They use that fortified balance sheet not to repay society in full, but to fund more buybacks. 3. Dangerous debt. The cheap money cycle I described earlier is orchestrated by the Federal Reserve. Companies load up on debt that the broader economy is on the hook for if things go south. So it's not their money. It's subsidized money, rescued money, and leveraged money, where the impact of failure falls on everyone else. Calling this a pure market decision is a fantasy. Second, the state isn't a passive observer, it's an active architect through the tax code. Our system famously taxes capital gains at a lower rate than ordinary income. But more specifically, it treats buybacks differently than dividends, even though the economic effect for shareholders is similar. This creates a powerful incentive. Executives prefer buybacks because they can quietly boost the stock price, which benefits their options, without the perceived permanence of a dividend. The rules of the game are literally written to encourage this form of wealth extraction over other uses of capital, like paying workers more or investing in a sustainable transformation. It's a policy-driven mindset. This brings us to the powerful chilling and revelation. When you step back and look at the coordinated action, the lobbyists shaping the tax code, the SEC crafting the safe harbor rule, the boards designing compensation packages that incentivize the pump, the banks underwriting the debt, you see a pattern. It fits a classic definition of organized crime, a group acting in concert to obtain illegitimate gains, corrupting institutions, and hiding behind a facade of legitimacy. The Bastidor's reality is a sophisticated operation. Wall Street isn't a chaotic marketplace of ideas. It's a highly coordinated engine for extracting wealth. And stock buybacks are the clean, legal-looking tool that makes the whole machine hum. The jornadas of $1 from a corporate tax break to an executive's yacht is a pre-planned route. Realizing this changes the entire framework. This isn't about good or bad individual CEOs. It's about a system designed to produce this outcome. Legal does not mean moral, and it certainly doesn't mean economically sound. The disguise of legality is the most powerful tool this system has, because it makes critique seem like an attack on the very rules of the game, when in fact, it's an attack on a rigged game posing as a fair one. What's the one-word label for a system that hides behind laws it helped write? Comment below. Rigged. Now I want to go even deeper into this subject, because seeing a rigged system can leave you feeling powerless, but that's the exact feeling the architecture of corruption counts on. The moment you believe change is impossible, they've won. So let's shift the mindset from diagnosis to prescription. Is there a way out? Can this machine be dismantled? Absolutely. It was built by human decisions, and it can be unbuilt by better ones. This isn't about a revolution. It's about a series of precise, strategic corrections that realign incentives with the real world. The first and most direct path is through the power that created the loophole in the first place: regulation. We need to re-examine the very rule that started this, SEC Rule 10b-18. That safe harbor needs to be dismantled, putting the burden of proof back on corporations to show they aren't manipulating their stock. Even more potent would be a significant tax on buybacks, making them a far less attractive tool compared to paying dividends or, better yet, investing in productivity and wages. Imagine a transformation, where $1 spent on a worker's salary gets a tax advantage over $1 spent on financial engineering. We could go further, requiring that major capital allocation plans, including massive buybacks, get approval not just from a board chasing its own stock-based pay, but from a broader panel of certified stakeholders, including worker representatives. This changes the journeys of capital at its source. But you and I aren't in Congress. Our second path is behavioral and speaks directly to our power as investors, even indirect ones. Most of us participate in the market through retirement funds, 401ks, and ETFs. These massive funds vote on corporate policies. We can pressure them. Demand that your pension fund or the manager of your index fund votes against share buyback proposals when they come up for a vote at shareholder meetings. Push them to support proposals that tie executive compensation to long-term metrics like R&D investment, carbon footprint reduction, or worker retention, not just the stock price. This is a quiet but massive leverage point. When the capital itself starts demanding real value creation, the impact here will be immediate, which leads to the third, most profound solution: a structural overhaul of corporate purpose itself. We must sever the direct, addictive link between executive pay and the short-term stock price. This perverse incentive is the engine of the entire scheme. The revelation is that we need new metrics for success. What if a CEO's bonus was tied to the company's innovation pipeline strength 10 years out? Or to the median wage growth of its employees? Or to the sustainability of its supply chain? This shifts the entire mentalidad of leadership from pumpers to builders. It's a move from a culture of extraction to a culture of stewardship. This isn't a radical idea. It's a return to the patience that built the industrial giants of the past. Understanding these paths forward is crucial. It moves us from outrage to agency. The truth occulta is that the $7 trillion lie persists because we've accepted it as the water we swim in. But the rules can be rewritten. The 1982 rule was a decision. A new rule in 2025 or 2030 can be a different one. The weapon against a coordinated system is coordinated knowledge and pressure. This is about repairing the bastidors machinery of our economy so it works for the many, not just the few. What's the one word that defines the choice we have to make? Comment below. Change. And if you've made it this far, it means you're one of the few who truly looks beyond the headline. You see the gears turning behind the curtain. That shared understanding is exactly why this channel exists. So, if this deep dive into the real mechanics of power resonated with you, here's how we keep this going. First, that like button is right below. Hitting it is more than a thumbs up. It's a signal that you're part of a conversation that values substance over spin. It helps this message find its way to others who are ready for it. Second, drop a comment below and let me know you're here. Just write "full watch" so I know who's in the trenches with me. Your thoughts, your takeaways, and even your critiques are what make this a dialogue, not a monologue. They directly influence what we break down next. And if you want to make sure you don't miss that next breakdown, hit that subscribe button. Every week, we take apart another piece of this architecture: the hidden systems, the white-collar crime models, the history they don't teach. Subscribing is the best way to ensure you're equipped with the knowledge to see the whole board. The story doesn't end here. The buyback machinery is just one part of a much larger system. To really understand how the game is played, you need to see the other players. I've got a video right here that tackles the other half of this corrupt equation, the agencies that are supposed to be the watchdogs. It's the perfect companion piece to what you just watched. I think you'll find it just as revealing. Thanks for your time and your curiosity. I'll see you in the next one.